I am Nayan Chanda, editor of Yale Global Online, and we are delighted to have with us in our studios Professor Carmen Reinhart, Professor of Economics from the University of Maryland. Professor Reinhart, who has served as Deputy Director of Research Department at the International Monetary Fund, has written with her former colleague Ken Rogoff a magisterial book. This time is different. This is a book that studies and draws conclusion from the economic crisis that has been on this planet for last 800 years, and she has studied the case of 66 countries. So the insight that Professor Reinhart and Rogoff bring to the table is almost unmatched. So welcome, Professor Reinhart.
Thank you.
So the title of the book is "This Time is Different." Obviously, it is a sarcastic title. Now, tell us why the crisis that we are currently now experiencing is not different from others.
Crises, economic crises, financial crises are a lot like illnesses, that if two people, one is 16 years old and healthy otherwise, and a 70-year-old that's less healthy otherwise, get the same illness, they're going to manifest themselves in some different ways, but that there'll be common symptoms. And this book is importantly devoted to those common symptoms, common causes, common symptoms, common aftermaths. This crisis, like most of the crises that we document, begins with a spark in financial innovation, securitization of mortgages. But most importantly, that translates into a lending boom, a borrowing frenzy. And in the United States, this is happening. This is happening in Spain. This is happening in the UK. It's happening in Ireland. It's happening in Greece. And this lending boom is fueled by borrowing from abroad, big current account deficits, large capital inflows, borrowing from abroad to finance those deficits. And not surprisingly, when you have a lending boom that goes on and on, the quality of your lending begins to deteriorate very markedly.
Now, if I could stop you for a minute, why this lending boom requires that there should be lenders available, there should be capital available to be invested.
Indeed.
So this surplus of capital that was waiting to be invested was in the United States as well as abroad. And how did it happen? How did this build up?
Well, my co-author, Ken Rogoff, together with Maury Opsahl, a former professor of mine, have written a lot also about global imbalances. And I'm going to focus on that part of the global imbalance that is more germane to the crisis. That is, I mentioned that the origins of this lending boom and the ability of financial institutions to lend was made possible by not only very low domestic interest rates and relatively loose financial liquidity conditions domestically, but also importantly fueled by borrowing from abroad. And specifically large capital inflows from China and other countries that were financing.
So they were stacking up a huge trade surplus, and they are investing those surplus in U.S. Treasuries.
In U.S. Treasuries. And so liquidity was quite plentiful. When liquidity is quite plentiful, lending follows, and less emphasis is placed on the quality of the lending, And let's not forget that during these lending booms, it's a feast and famine cycle, right? This is a feast. And in the feast, you have lots of lending, big booms in asset markets. You have booming equity markets. More notoriously in this time, you also have booming real estate markets. And at some point during this process, the leveraging really reaches a point where even small negative shocks can begin to call into question the solvency of many of those who had borrowed. After all, much of the lending was, you made a loan, a mortgage loan, not because necessarily you thought the quality of the borrower was great, but because, after all, the collateral, the real estate value, was going to keep going up and up.
Yeah, that's the assumption. Yeah.
Indeed.
Now, interest rate was kept low. What was the rationale for that? Why did the Fed do that?
I think the main reason one can point to is that monetary policy in the United States and in most economies, certainly the advanced economies, has a price stability objective. And inflation was certainly not raising its head in a way that was alarming. So the case for the kind of very tight money, for example, that we saw in the late 70s, early 80s, when we were trying to bring inflation down, you couldn't really make a case for that. But I importantly want to highlight that it's the perfect storm component of it is that you not only had domestic liquidity, but you were also borrowing heavily from abroad. Very large current account deficits, persistent, I may add, current account deficits, have been a hallmark of crises in advanced economies and emerging markets before World War II, since World War II, whichever way you want to slice the sample.
But this current crisis, can it be traced back to sort of 80s or 90s? When did this balance start going so all right?
The deterioration in the current account doesn't always persist and doesn't always reach the magnitudes, reaching record levels for the United States, for example, that it reached in the years just before the crisis. So one can't really go back to the 80s and say, aha, this was a current account deficit, therefore this is a signal, this is because current account deficits widen, sometimes narrow. It is the persistence.
So on its own is not enough indicator.
Right. And I also would highlight that what is notable is when they become very persistent and very large. And during that boom period is when this time is different, is at its heyday. Because when things are going well, nobody wants to heed the signs that, well, the last time that we saw debts go up this much, this suddenly, it ended badly. You have to go back, in the case of the United States, to the roaring 20s to get the very rapid increase in private debt.
Which resulted in the Depression.
Indeed. And so when the going's good, you don't find a very receptive audience in saying, well, this is not going to last. People have lots of reasons why, in effect, this time is different.
Right. So, looking back in the past, you have seen the same pattern repeat itself. Now, in terms of availability of foreign funds, this massive liquidity that came to the United States, isn't that somewhat unique this time, or was it the case before?
I would say it is unique to the United States, but not unique as a pre-crisis phenomenon.
Okay.
If you look, let's talk for a moment about the 1997-1998 Asian crisis. That crisis was, for that region, as significant as the subprime and its aftermath has been for the United States and for Europe. That crisis was preceded by the very same kinds of patterns that I've described. Large capital inflows, big current account deficits, notably in Thailand and in Malaysia, lots of borrowing from abroad. A lot of the borrowing at that time was coming in the form of borrowing short-term from Japanese banks. The period of the boom was also characterized by rapid increases in real estate prices, in equity prices. This is not things that I'm just stating as acts of faith. Ken Rogoff and I document this extensively, these housing price booms, these equity booms, these surges in indebtedness are documented in painstaking detail in the book. And so naturally, it's naive to believe that every crisis is going to follow every exact same, detail of the pattern. For example, one element for the United States where this crisis was different was that most often during the heyday of the crisis, during the abyss, which would be the fall of 2008, in the current crisis, you see a currency crash. You see the value of the currency collapse. That was true certainly for Thailand, for Indonesia, for Malaysia, and so on. It was true for the UK in the current crisis, for example. But what did we see? Well, the dollar is the reserve currency. And so
in other words, everybody wants to save their resources in dollar.
Absolutely. So you had a flight into the dollar.
Despite the fact that the U.S. is having crisis, still money pouring in.
Yes, it's not often you see people running into a burning building, but that's what we saw during the fall of 2008.
Yeah.
And that is not the typical pattern. So each crisis will no doubt has its own flavor, but as I said, we indeed do document many common symptoms.
So that was one thing different. Now, the deregulation that preceded the current crisis, is there a precedent like this in the past in the U.S. history?
Yes, but it's not after World War II. What I have been highlighting time and time again, Ken and I have put together a series of tables and charts in one of the final chapters of the book that traces out, for lack of a better term, an index of world turbulence. And the kind of world turbulence, especially in the advanced economies, that we've seen since 2007, you have to go back to pre-World War II. So this phenomenon is not one that policymakers in the United States or in Europe have faced before in their professional careers. Emerging markets policymakers have had to deal with this phenomenon. If we go back to the 1990s, there's no lack of crises. There was the Mexican crisis of 94, 95, the Asian crisis, which engulfed a number of countries in 97, 98, the Russian crisis in 98, the Brazilian crisis in 99, Argentina, 2001, and so on. So emerging markets have been rocked by these very traumatic financial meltdowns in the recent past, but I like to remind people that prior to subprime crisis, very much a received wisdom was that we had entered the great moderation phase, in which the advanced economies had tamed the business cycle. That was, I may add, a very short phase historically.
The repeal of the GlassSteagall Act, how much of a role it had played in this buildup of the debt?
That is an excellent and difficult to answer question, but let me go with that. In the book, Ken and I have, in the section on banking crisis, shown that if you take a big perspective from 1800 on, 210 years approximately, you look at an index of international capital mobility, and you count the number of crises, the banking crises per year. Those periods in which capital mobility was very high, you had a lot of banking crises. Now, Glass-Steagall per se wasn't about capital mobility, but it was about regulation of the financial domestic system. And domestic financial regulation, however, has often gone hand in hand with the regulation of international capital movements. And so, for example, the period from World War II to the erosion of Glass-Steagall in the early 80s was a period of very low incidence of severe financial crises in both advanced and emerging markets. But as de facto, if not outright de jure, the capital markets begin to find ways around Glass-Steagall, and liberalization takes hold, we see the incidence of banking crisis rise. So I am giving you a long answer to what is it, but it's beyond Glass-Steagall, you see. It's about financial liberalization and capital mobility. Laissez-faire, maverick financial markets are more volatile. They engage in more risk-taking, and more crises follow.
So the financial regulations that have now been drawn up, the DoddFrank Act, this is kind of trying to close the barn door after the horse had.
Indeed, and the horse left a long time ago. I think it is moving in the right direction, but that's about what you can say. It's not particularly ambitious in terms of the levels of capital requirements. The Swiss authorities were noting very recently, the last few days, that they thought Swiss banks, some of the big Swiss banks, needed much higher capital requirements. It's also not very ambitious in terms of how long you have to meet those requirements. They're really spaced out over quite an extended period.
Yeah. So trying to soften the blow in terms of...
to put it gently, yes.
Right. Yeah. Now, the current sort of looks like the economy has kind of been stalling almost. The growth rate has dropped quite substantially. And again, from the past experience, how do you think, what are the instruments available at this point to the U.S. government to stimulate the economy back to life?
Let me divide my answer to that question into two parts. The first part is one that, the second part, the stimulus question, is one that's been all over the press and, very much in the public debate. The first part, puzzling to me, and more than that, worrying to me, isn't discussed nearly as often, if it's discussed at all, which is, let us go back to the origins of the crisis. The origins of the crisis was that the banking, or more broadly defined financial industry, has a lot of bad loans. It made a lot of bad loans And here we are 3 years later with balance sheets that still have a lot of bad loans.
And this is mostly in real estate?
Importantly in real estate, yes. Not exclusively, because again, as the economy wavers with subpar growth for a longer period of time, it is easier for loans to cross the threshold from being illiquid to default. But what I'm getting at is that what could the authorities do? I think a very sober re-examination of bank balance sheets with an eye to writing down, taking haircuts, marking to market some of those artificially inflated loans is a necessary step in dealing with the debt overhang that we have. Japan failed to do this for a number of years. Ultimately, it had to be done. I'm afraid that we really run the risk of going down that route. Now, turning to the stimulus question, subsequent work to the book that Ken and I have done has highlighted that at high levels of debt, historically, you have observed on those years in which debts are very high, lower growth than average or lower growth than the median. Where does that leave me as regards stimulus? Well, I've also done work with Vincent Reinhart, my husband, in a Brookings paper that also highlighted that part of the problem in the recovery of the Great Depression wasn't just about a withdrawal of stimulus, which certainly was a problem, but also a zigzag pattern in fiscal spending. A boom in one day and a contraction in the other. And so I would be very scared by a sudden withdrawal of stimulus from the current rather precarious situation.
The stimulus is being phased out, basically.
But how quickly it's pared down is of significance here. And the need for further stimulus is an attempt to make that a softer withdrawal of the fiscal impulse, because a sudden one, as our work and others' work has shown in the Great Depression, was very problematic for producing a double dip. Having said that, is announcing stimulus and calling it a day sufficient? I don't think so. I think that providing stimulus over the near term is critically important, but at the same time, I think it is also critically important that the fiscal authorities or powers that be in the United States announce to the public a credible plan to deal with a ballooning deficit and a ballooning debt. It's important to note we haven't been here in these levels of debt.
So politicians have to be honest to the public to say,
yes,
we have to perhaps increase the stimulus in the near term in order to tackle the question of debt overhang more urgently in the near future.
Yes, and to offer the elements of a concrete plan. And it's not going to be popular. I don't know any easy ways of bringing down debts and deficits. They're not going to be popular.
Because it would either mean cutting services or raising tax.
Or both.
Or both.
And so, hence my statement about
Yes,
not being popular. But as unpopular or unpleasant as that may be, I think it's also the responsible thing to do. We cannot sit here, and again, reiterating that more stimulus is needed in the short run, we cannot sit here and pretend that debt doesn't matter for us.
Yeah. And that's your survey of last 800 years of history show that
It does.
that debt is something that has to be tackled sooner the better.
Yes.
Well, Professor Reinhart, thank you so much for speaking with us.